Hello friends, this is Sahas Academy. We are presenting India Macro Market Analysis. It covers global and India-centric events impacting currencies, interest rates, equities and gold. Before start of episode 4, let's have a brief overview of the week gone by. Last week Bank of England and Norges Bank hiked the policy rates by 50 basis points, whereas Swiss National Bank raised its policy rates by 25 basis points. Fed skipped the rate hike this time but indicated further tightening in policy rates to tame sticky inflation. On the other hand, in Asia, China is struggling with slowdown in economic activities and lowered the lending rates by 10 basis points to stimulate the economy. Japan is continuing to maintain ultra-easy monetary policy to focus on economic recovery. Back home, Indian economy is continuing to show resilience, and data shows upbeat economic activities. RBI has put a pause on interest rate hike and expected to maintain it for long, as economic activities are showing resilience to weaken global growth outlook. With this, let's start our India macro market analysis for the week with episode 4. Let's start first with global events and news from US economy. In the week gone by, market was awaiting Fed's testimony to lawmakers to get further directions. In the testimony, Fed's Chairman Powell stated that inflation is still higher, and further tightening is needed to bring back inflation to the targeted level of 2%. He also mentioned that it is a long way to bring it back to the target. This indicates that compared with last year, there is now less urgency to move quickly. Economic data would play a key role in the Fed's decision-making. On data front, upbeat consumer sentiments, better consumer spending data, and housing stats, which indicates bottoming of housing market, are indicating resilience in US economic growth and warrants rates hike in next policy meeting. Rise in job loss claim data is an initial sign of cooling job market. Market is of the view that economy is set to slow. Further, it expects that the recessionary conditions lead the Fed to ease monetary policy towards end of the year. From Eurozone, ECB members are continuing to maintain rhetoric on inflation. Two members of the ECB are of the opinion that further interest rate hikes are warranted, as inflation could come even higher than it expects. However, ECB's chief economist Philip Lane expressed the need to follow a data-dependent approach. European Central Bank Vice President Luis de Guindos said, inflation is sure to moderate, although the pullback in core price pressures may not be so pronounced. On the other hand, as per Bank of France Governor, Villeroy is of the opinion that ECB has completed most of its rate hike path, and possible further hikes would be less important in fighting inflation than the duration of tight monetary policy. ECB Governing Council member Madis Muller of the opinion that wage increase poses a key threat to the euro area inflation outlook and will lead to decline in core inflation slower than the current forecast. Now, let's move to UK. The Bank of England has raised policy rates by 50 basis points to 5%, defying market expectations of 25 basis points. Moreover, the policy bank has provided a hawkish guidance by stating that more tightening might be required if inflation pressures remain persistent. Economic activities, especially housing sectors, will impact and has cascading impact on entire economy and banking sector. With the steep rise in policy rates, housing rates with fixed lock-in period will roll over to present rates. This will leave lesser disposable income in the hand of consumers and triggers defaults on housing. In UK, growth is expected to slow down further and raises recessionary fears. Now, we will move to Japanese economy. Bank of Japan continuing with its ultra-easy monetary policy, with the focus on economic recovery. Though inflation has risen, any rate hike is not on the card yet. As per Bank of Japan's policy meeting minutes, it debated the risk of being too late in raising interest rates and falling behind the curve as wages and inflation are showing sign of acceleration. BOJ board member CZ Adachi is of the opinion that it was too early to phase out ultra-loose monetary policy, given the high uncertainty over the price outlook. Now, let's move to Chinese economy. China is peculiar to other Western countries, as country is running with almost zero inflation and facing growth slowdown. Western countries are on rate hiking cycle, whereas China is lowering rates to support falling growth. During the week, China has lowered benchmark lending rates by 10 basis points. Rate hike is lower than the market estimates of 15 basis points. Forecasts by China's National Petroleum's research arm suggests that demand from China will remain muted, further indicate weakening economic activities. Weak manufacturing activities and economic data, raising market expectations of fiscal stimulus to support the economy, which has led to rally in commodities. Further markets are expecting RRR cut to boost credit growth. Now, we will move to Indian economy for news and events during the week. Indian economy is continuing to show resilience, which is further indicated by rise in net direct tax collection. Till 17 June 2023, direct tax collection rose by 11.18% and growth in advance tax collection is at 13.7% on the back of strong earnings from corporates. Formal job creation under the Employee State Insurance Scheme registered a growth of 2.8% month-on-month in April. Rise in crude imports by 2% in May are pointing to strong economic activities in the country. MPC minutes stated that economic prospect in the country has improved. All these are pointing to improved economic outlook and resilience in economic activities. However, geopolitical risk and global growth concerns will be a risk to growth. On inflation side, though inflation is cooling, which is supported by soft commodity and crude prices, El Nino condition, and delay in monsoon may put upside pressure to inflation due to rise in food prices. Continuous rhetoric from central banks across to rise in interest rates to tame sticky inflation will put RBI on long pause. Now, we will move to next section, market analysis, and start our discussion with USD INR price movement during the week. During the week, USD INR was traded range-bound and looking for fresh direction. The currency pair moved in the range of 81.95 to 82.17. Fundamentally, India's external sector is on strong footing, with foreign currency reserves are close to $600 billion, and current account deficit is falling on the back of rise in services exports. PLI-linked initiatives are further supportive for India's manufacturing sector and exports. This can be gauged from the rise in mobile phone exports from India. Further, soft commodities and crude prices are supportive for India's external front, as India is importing economy. Moreover, with strong growth fundamentals, where the large economies are facing with slowdown and recessionary concerns, Indian economy is showing strong resilience to global headwinds, and even economic activities has improved from January, as per the MPC minutes. This will make India an attractive destination for equities. Rise in equity flows is further supportive for the INR appreciation. Despite positive sentiments, we believe any sharp appreciation in the currency pair will be curtailed due to RBI's intervention in the market, as it will make Indian exports uncompetitive. Depreciating Chinese currency will put a cap on rise in the rupee. We believe RBI will continue to intervene in the market to buy dollar and infuse rupee liquidity in the system, which it will continue to mop up through variable reverse repo rate operations. In our view, this will push RBI to continue to maintain with withdrawal of accommodative stance. Technically, 81.90 is a support zone in the currency pair in daily charts. Break from these levels will take the currency pairs to 81.65 levels, which are also indicated by the weekly charts. On the upside, 82.36 is an immediate resistance. Now, let's move to dollar index. In weekly charts, dollar index is taking trendline support at 101.90 and snapped the 3 weeks downside move and closed the week at 102.90. Better spending and housing stats data provided the fundamental support to the index. Powell's remarks further fueled that rate hike cycle is not yet over. This indicates US economy is doing good despite some weak data in the past weeks. Labor market is continuing to show strength, though there are some initial signs of cracks in the strength of labor market. Technically, 101.95 will be a support with a resistance at 104.20. Now, let's move to crude oil. The rise in crude prices after the announcement of Saudi Arabia to cut production tapered off due to growth concern in China and Europe. News of Iran and US reaching an agreement on nuclear deal lead to fall in crude prices. Despite the news, it could not break support level of 70.63, as heard in the market that Iran's oil production and exports is at peak. Any relaxation on sanction will not have impact on supplies. As market digested the news of Iran deal, prices recovered back to 76 levels. Forecasts by China's National Petroleum's research arm suggest that demand from China will remain muted, and Powell's remarks of further tightening fueled recessionary concerns and led to sharp drop in prices to 72.11, where it taken a support at trendline and closed the week at 73.85. As per JP Morgan report, supply has rebounded and surprised to the upside from a number of sources, like US and other non-OPEC members. Technically, 76.50 is immediate resistance with support at 72.11 and 70.63 levels. Now, let's move to Bloomberg Commodity Index. Bloomberg Commodity Index has broken the channel's upper band on the back of stimulus expectations from China. Further, news from Russia to reconsider grain deal also fueled the rally in commodity prices. El Nino conditions will put upward pressure on food prices. Lower than expected lending cuts by China, fading expectations of fiscal stimulus to support economic growth in China along with global growth concerns, as major central banks are continuing to maintain hawkish stance, led to reversal in commodity prices. Though index traded below the support level of 102.27, it closed the week at the support level. We expect global growth concerns will continue keep a lid on any sharp up move. Technically, 104.60 will be resistance and immediate support at 101.62 and 100.60 levels. Now, let's move to equity to analyze price movement during the week. We start this week's Indian equity market discussion by comparing the weekly chart of Nifty 50 with that of DAX, Germany, CAC 40, France, and Dow, USA. Two very important things come to our notice. Firstly, Indian market completed its medium-term correction in June 2022 itself and started the uptrend, while other three major markets had its correction as late as September 2022. Secondly, in spite of having correction 3 months later than Indian market, those markets have already started showing weakness and have already broken the lower support of the channel. On the contrary, Indian market is chugging along since June, albeit with a small correction in September to be in line with global trends, and is currently very much within the rising channel. This comparison clearly shows that Indian stock market has some extra strength for the time being and in near future. In macro development, the week started with good news that till mid-June, this fiscal year, net direct tax collection was 11% higher compared to the same period last fiscal. Direct tax includes corporate tax, personal income tax, STT and other similar items. This indicates robustness of the economy. Rest of the week, we were enamored by Indo-US strategic dialogues and its fallout in business arena. The first major outcome from Prime Minister Modi's visit was a flurry of investment declaration by leading semiconductor companies. Leading US semiconductor and data storage company, Micron Technology, committed more than $800 million on a new $2.75 billion semiconductor assembly and test plant in India, with funding from the semiconductor mission in the next 5 years. The company will employ a workforce of 5,000 and create an additional 15,000 community jobs over the same period of time. Foremost, microchip design technology company, Applied Materials, has also announced that it would establish a semiconductor center for commercialization and innovation in India, at a capex outlay of $400 million over 4 years. It was also announced that Lam Research will train 60,000 Indian engineers as part of its Semiverse solution to help the country meet its semiconductor education and workforce development objectives. In our opinion, this is the most high-impact development for Indian economy, commerce and business. This will create an ecosystem of semiconductor industry and is likely to have huge impact on India's growth in coming decades. Tesla also announced its intention to enter India at the earliest possible. This will again help create an ecosystem around EV, energy storage, autonomous vehicles, etc. Hindustan Aeronautics and General Electric signed an initial MOU to manufacture F414 engines in India. The detailed contour of this is yet to unravel, and to what extent this will have cascading benefit to Indian small and medium enterprises are not clear yet. It has also been reported that India has been inducted into the Mineral Security Partnership, MSP, a US-led collaboration of 14 countries that aims to catalyze public and private investment in critical mineral supply chains globally. This primarily deals with lithium, rare earth elements, and transition state metals. They have application in high-end electronics, energy storage, etc. This grouping is aimed at preventing China cornering global sources of such important elements. The present declaration is more of an intention, and how it will help developing the Indian strategic electronics ecosystem remains to be seen. However, this innocuous declaration has huge potential for Indian economy. Coming back to equity market outlook, we clearly see that leading Indian indices, Nifty 50 and Nifty Bank, are in a sideways correction mode. The vertical line indicates 15th of March, 2023. The last candle represents 23rd June 2023. What is interesting to notice is that for last 2 to 3 weeks the Nifty mid-cap and small-cap stocks made a nice clean sweep to the top and undergoing correction for last 2 days. While Nifty 50 and Bank Nifty are volatile with sharp up and down moves for more than last 2 weeks, and lacking a sense of direction compared to mid-cap and small-cap stocks. Our sense is that in the coming week, Nifty 50 and Bank Nifty will be soft. However, Nifty 50 has several supports on its way down. The first support is at 18,650, 20 DMA, followed by 18,440, and then at 18,050 to 18,100. There is a zone of congestion. On the upside above 18900, there is a blue sky territory, and the first technical resistance is at 19,430. Bank Nifty will find support at 43,330, 50 DMA, on its way down, followed by 43,250, low bowling a band, and 42,950. Above 44,500, it is a blue sky territory, and the only technical resistance is at 45,600 and 46,400. Now, we will move to our next section, Indian Government Securities Price Analysis. Present fundamental factors are indicating bond yields in India to move higher in the short term. RBI is focusing on anchoring the inflation to its mandate of 4%, which it has reiterated in the recent policy meeting. In the RBI minutes, there seems to be diversion of views. In MPC's minutes, RBI's members focused on anchoring inflation expectations, whereas external members are raising growth concerns and damaging impact on economy for keeping rates higher for long. Considering El Nino conditions and delayed monsoon, there may be upside pressure on inflation due to rise in food prices, though commodities excluding food and crude prices will continue to be benign due to global growth concerns. Presently, India's economic growth is showing resilience, which is evident from strong e-way bill numbers, elevated manufacturing and service PMI data. Consumer sentiments from rural continue to show buoyancy. In our view, MPC will wait for more data points before taking policy decision and stance change. We also believe that RBI to follow long pause. Further, higher bond supplies from states will continue to put upward pressure on the yields. Considering RBI to follow long pause and hawkish tone from central banks across, extent of any downside moves in yields also appear to be limited. Technically, in 10-year India government security, yields have broken the 7.08% level and moved upside. However, later it retraced back to 7.06% and closed the week at 7.07%, which is below the resistance of 7.08%. In daily charts, momentum is positive. We are expecting 10-year government security to move towards 7.18% levels, which is a 23% Fibonacci retracement of the entire move, from 5.75% to 7.63% levels. In the weekly chart too, there is uptick in momentum. Fibonacci speed resistance will provide the support to the up move in the yield. In the 5-year government security, yields have broken Fibonacci resistance level of 7.02%, which is the 23% Fibonacci retracement of the down move, from 7.50% to 6.88%. Yields are now holding in the range of 7.04% to 7.06% levels. As in the past, these levels were supported, hence, it will be a good resistance zone. Upside break from 7.06% will take the yield to 7.11%, which is the 38% Fibonacci retracement level. On the daily charts, there is a strong upside momentum. Barring near tenors, yields have risen across the curve in the last week. Shorter dated is more driven by liquidity. Since RBI is maintaining neutral liquidity in the system, near tenor rates are more or less stable. Credit growth is continuing to stay elevated, and deposit growth is lagged. We expect banks will bridge credit demand by raising CDs in the market. It will drive the credit curve higher. Now, let's move to US Treasuries analysis. US Treasuries are consolidating at current levels. During the week, there were mixed set of data. Higher consumer sentiment and better consumer spending data along with housing market stats, which indicate housing market has bottomed out, had put the upward pressure on the yield. In the Fed's testimony before the Senate Banking Committee on Thursday, Powell suggested policymakers would continue to raise interest rate to bring down inflation. However, compared with last year, there is now less urgency to move quickly. Economic data would play a key role in the Fed's decision-making. Market is of the view that economy is set to slow. Further, it expects that the recessionary conditions will lead the Fed to ease monetary policy towards end of the year. The job loss claim data has inched up and continue to remain elevated for a third straight week. It is being seen as an early indicator of a softening labor market in the face of the Federal Reserve's aggressive credit tightening. This has put a lid to the upside yield movement. Technically, 10-year US Treasuries will move in the range of 3.57% to 3.87%, with immediate support at 3.68%. Inflation and employment data will provide further direction to the market. Yeah, let's wrap our discussion. Thank you for watching the video. If you have any suggestion or feedback, you can reach us at info@sahasacademy.com or visit our website www.sahasacademy.com. You can also reach us through social media platform LinkedIn, Facebook, Twitter and Instagram. To encourage us to share more videos, please subscribe to our channel. Thank you. Disclaimer: this video is made for educational purposes. It does not constitute an advice. Please consult with your investment advisor before taking any investment decision.